16th September 1992. London, 8:30 in the morning. Officials at the Bank of England are in absolute panic. Telephones ringing non-stop, red figures flashing across trading screens. Sterling is falling, and it keeps falling. In a New York office, a single man has placed a $10 billion bet against one of the world's most powerful central banks. And in just 24 hours, he will make $1 billion. This is the story of how one man brought the Bank of England to its knees. Chapter 1. Who is this man? George Soros. Today, this name is legendary in the financial world, but on that day in 1992, this name would be carved into history. Born to a Hungarian Jewish family, Soros survived the Nazi occupation, emigrated to Britain, and studied economics here. In 1969, he founded his own hedge fund, Quantum Fund. But there was something that set Soros apart from the rest: reflexivity theory. According to Soros, markets aren't always rational. People's beliefs and behaviors can shape reality itself. And this was precisely the theory he was about to apply to the biggest bet of his career. Chapter 2. Setting the stage, the ERM system. To understand our story, we need to travel back to the 1990s, to Europe. At that time, European nations were pursuing a grand dream: a single currency. The foundations of the euro were being laid, and to realize this dream, a system had been established: the European Exchange Rate Mechanism, ERM. The logic of the ERM was straightforward. European countries would maintain their currency's values within a specific range relative to the German mark. For instance, the British pound was pegged at 1 mark equals 2.95 pounds, and this rate could only fluctuate by 6% up or down, which meant sterling had to remain between 2.78 and 3.13. If it fell below this, the Bank of England would intervene, purchasing pounds to prop up the value. On paper, a brilliant plan. In reality, a recipe for disaster. Chapter 3. Britain's enormous problem. Britain joined the ERM on 8 October 1990. However, they made a critical error from the start. Sterling's value was set far too high. Consider this: inflation in Britain was at 10%. In Germany, merely 3%. Britain's economy was sliding into recession. Unemployment was rising. Normally, in such circumstances, what would a central bank do? Lower interest rates to stimulate the economy. But the ERM system wouldn't allow it, because if you reduce interest rates, sterling weakens further and drops below the ERM band. Britain was well and truly trapped. It needed to lower rates to revive the economy, but it needed to keep rates high to protect sterling, and the markets had cottoned on. Chapter 4. Soros's Plan. By the summer of 1992, George Soros was conducting crucial analysis in his office. The data was crystal clear. Sterling was trading well above its true value. Britain's economy was in dire straits. The Bank of England was spending billions defending sterling, but this couldn't continue indefinitely. Soros' strategy was this: short selling. Here's the simplified version. 1. Borrow billions in pounds. 2. Immediately sell these pounds, buy German marks. 3. Wait for the Bank of England to fail in defending sterling. 4. When sterling crashes, buy back the cheaper pounds. 5. Repay the loan and pocket the difference. Simple? Yes. Easy? Absolutely not, because he was up against one of the world's most powerful central banks. But Soros knew one thing: the market is always stronger than the central bank. Chapter 5. Black Wednesday, 16th September 1992. Evening of 15th September. German Bundesbank President Helmut Schenziger told a journalist 1 or 2 currencies might come under pressure. The world took these words as a signal regarding sterling. Soros moved immediately. 16th September morning, 8:30 a.m. Soros and his team increased their short position from $1.5 billion to $10 billion. Yes, you heard correctly, $10 billion. He was borrowing and selling pounds from everyone he could find, and when other hedge funds noticed, they did the same. It was like a domino effect had begun. 8:30 a.m., the Bank of England began intervening. They were purchasing £2 billion every hour. 10:30, Prime Minister John Major called an emergency meeting. Decision: raise interest rates from 10% to 12%. Perhaps this would deter the speculators. But it didn't work. Sterling continued to plummet. 1400, a desperate move. Rates hiked to 15%, an unprecedented level in history. But Soros and the other traders didn't stop because they knew Britain couldn't win this battle. Their reserves were depleting. 1930, game over. The British Prime Minister made an announcement. Britain is withdrawing from the ERM system. Sterling will float freely. That evening, sterling lost 15% against the German mark, lost 25% against the dollar. The Bank of England lost $3.3 billion. George Soros, in just one day, made $1 billion. Chapter 6. Consequences and Lessons. Black Wednesday wasn't merely a financial event. It was an event that altered the course of history. For Britain, in the short term, it was humiliating. The government lost credibility. But, ironically, in the long term, it was beneficial for Britain. After leaving the ERM, they could lower interest rates. The economy grew rapidly. By the late 1990s, Britain's economy had become one of Europe's strongest. For George Soros, Soros entered the history books. No longer just an investor, he'd become a legend. His moniker, the man who broke the Bank of England. For the financial world, this event taught 3 vital lessons. 1. Markets are more powerful than governments. If you have an unsustainable policy, the market will punish you sooner or later. No central bank has unlimited reserves. 2. Reflexity theory was validated. People's beliefs can create reality. Because everyone believed sterling would fall, it actually did fall. 3. Risk management is everything. Soros' success wasn't just about the correct prediction. He knew how to manage risk. If he'd been wrong, he had a plan to limit his losses. Closing. George Soros' move is remembered as one of the boldest and most profitable trades in financial history. Proof of how one person, with proper analysis, proper timing, and courage, can change history. But remember, this story isn't just about making money. It's about the fragility of economic systems, government mistakes, and the power of markets. Even today, traders worldwide study Soros' move and ask, when will the next Black Wednesday occur? So what do you reckon? Let's discuss in the comments.